Okay, everybody, I'm going to take you today through a rundown of how we got here into the Great Lockdown and economic recession resulting from it, as well as a bit on New York City's economic experience and talking a bit about what the reaction has been to the recession that at this point, suspect strongly we are in, if everything that is coming out as far as data isn't suggesting exactly that. But it is an interesting experience being in the midst of a recession with so much data to analyze and with such a basic, clear starting point. But I'll get into that as we get further in through the slides. I want to first, as you're going to see, take you through a rundown of what the risks were leading up to the situation, the correction we're dealing with today, the immediate causes, looking at least three very specific causes. And it's going to be interesting with some more time ahead to see what other causes get identified in the near future or what other risks were probably also ramping up leading up to this event that aren't necessarily in the insight right now, but it's also very interesting what things clearly led up to this and how much of this we were concerned about, considering that there were worries about a recession for months, well into a good part of 2019. There were suspicions of that, and with less data, worries even before then. I'm also going to take you through the theories around what the slope and the bend of the recession will be, as far as like what the downward trajectory may look like and when we maybe will trough and expect to start to see some recovery and what a recovery could possibly look like. After that, I'm going to focus a little bit more on the direct impacts to New York City and how those tie into some of the risks identified prior to, but also how this will likely take a particular toll on the city's economy compared to other parts of the country. And that is even in consideration of the amount of cases of COVID-19 being found in the city. Talk a bit about what the policies of a lockdown are as far as the fiscal and Federal Reserve policy responses, right? So take a look at what the Federal Reserve did leading up to this and during the correction as was occurring, or at least after the lockdown started coming down in the United States, and what the fiscal actions have been as far as what the federal government has been doing to react to this. Again, this is where it becomes very interesting because we are observing a correction or a recession that we effectively created the start time for. So in many ways, these policymakers had a good deal more information about the situation they were dealing with than has been the case in the past, and in some ways may have been able to react to it faster than would have been the case with a unexpected correction. And then finally, will it work? What will these actions work? What would it take for this to actually be successful? What does success look like with something like this? And should we, like, will that success be short term? Or are we talking about what it would look like in the long term? So getting into all of these aspects and particularly taking a look at what's happening in New York City. So I'm going to try to go through these not quickly, but on the faster side, in consideration that the slides will be available by link and you can go into them a little bit deeper. So first we'll start off here with the inclining risks and taking a look at the recovering economy and the vulnerabilities that exist therein. First place I wanted to start off with is the fallout in the price of oil after the Great Recession. Real price of oil never really recovered after the Great Recession occurred, and the price only went down from there starting in 2014 to where we are today. A large part of this could be attributed to fracking and other technological changes that made accessing oil a lot easier, especially in North America. And this is really the culmination of the United States' policy since the 70s of trying to be more energy independent. Now, the levels of oil being produced just within the United States, and this graph right here is of West Texas Intermediate. So these, we're talking about prices influenced tremendously by what's going on in the U.S. It's incredible that we have been able to bring down the price of oil as steeply as it is, even during like a recovery from 2009. But the experiences of the most recent days, April 20th, when prices went negative, are outstanding. And part of the inclining risk, the fact that oil prices never really did recover and had started declining since the Great Recession, is part of what becomes a problem later on in this correction. What you're looking at is a Brent price of real price for oil as well. Same pattern, declining since CGR. Collapse have, in the oil price since 2009, they've also correlated with a surge in debt among industries, oil company industries, or I should say oil industry companies. The level of debt to equity gives a reason to believe that these firms are becoming very leveraged, and was likely due to the fact that the product that they're processing, that they're selling, was becoming cheaper in its output price, right? So with these lower output prices, lower input prices, what the oil industry in general downstream is dealing with is just a cheaper product that leads to thinner profits per barrel, and means that each barrel will likely return a lower profit rate than it used to in the past. A way to get around that financially is to leverage up your operations. So the more leverage you take on, basically the more of someone else's money that you use to conduct your own business activity, the higher the profit margins for you in return for every unit of output that you create. So when you start to see these profit margins thin out, it's not unusual for these firms to start to take on more leverage. But they weren't really the only ones in the economy borrowing. When we start to look at the global corporate debt, it's really ballooned since 2009. We're talking about total corporate debt as 92% of world product by 2019, up from 84% in 2009. And the U.S., that has grown as well from levels of 111% of real GDP for non-financial corporate debt. Went from 111% of real GDP up to 132% of real GDP by 2019 from 2009. Same thing happens when you look at this debt as a proportion of the assets that these firms are holding. So either measure you're looking at, debt in the U.S. economy has been growing, at least corporate debt has been growing since 2009. That leverage was identified as a problem by many economists even before what's happening today. It's just poor. It's a poor sign to see so much cash flowing around in the economy, and a lot of that cash inevitably will be used for leverage situations that are just by nature, some of them will not be thoroughly thought through. And we may have seen a version of that happening in the oil industry. On top of that, the Treasury term premium started declining since the Great Recession as well. The term premium is the difference in the interest rate, the yield for U.S. Treasuries along a spectrum of time. So the difference between a U.S. Treasury that will be mature in 2 years versus a U.S. Treasury that will be mature in 10 years. The difference in that maturity should be reflected in the interest rate, right? Money that is tied up for longer should have a higher interest rate than money that will be tied up for less time. And what we see since 2009 is that the difference between those two time periods, for example, the 2-year Treasury versus the 10-year Treasury, has been declining. An indication that there's likely some stress building up in the economy that is just being reflected in people flocking towards safer assets, even if it is gradually over time. The fact that these rates start to flatten out, that the yield curve starts to flatten out, had always been a sign to many economists that something was going to happen soon. And then the inversions in 2019 were thought to be some sort of telltale of something happening in the deeper financial workings that we may not have a specific eye on, but was clearly occurring and manifesting itself behaviorally in investors flocking towards safer assets. Perhaps this was an indicator of the inclining leverage in the oil industry. But even beyond that, there are other risks that were kind of growing as the economy was recovering. A lot more vulnerabilities. For example, take into consideration a stress test for a household. Could a family afford a $400 emergency expense in this month? Or even if this month would be a bad example, let's say at the end of 2019, could your family have afforded a $400 emergency expense? Almost half of Americans could not, with only 59% saying that they could possibly afford that. And when you look at the options that Americans who couldn't afford it were turning to or would have turned to, the top ones are putting it on a credit card and paying it off over time, borrowing from a friend or a family member, selling something, using a bank loan or line of credit, and using a payday loan, deposit, advance, or overdraft. So all these responses indicate liquidity issues for households, but it's also interesting that a lot of the top options that would have been available to households involve participating in the economy and perhaps even involve face-to-face interaction in participating. So borrowing from a family friend or a family member, selling something. There is digitization that happens, and there are opportunities to do these transactions not face-to-face, but it's not necessarily as convenient or even for some people as trustworthy as doing some of these interactions or getting this liquidity face-to-face. So although households may not have been super leveraged themselves, at least in a longer term basis, they weren't really holding household mortgage debt, for example, as a huge proportion of their income. There were indications that there was stress in American households, as well as stress building up on the corporate side of the economy. And the stress can also be measured in the amount of inequality as far as net worth goes. So looking at this graph of median net worth, you can see that for only the top 20% of earners in the United States was there actually a recovery in net worth since the 2009 crisis. For the other bottom 80% of households, the vast majority of them really saw a flat to maybe modest recovery happening, even though one may argue that they didn't lose as much nominal wealth as was lost on the higher tier after 2009. The sharp recovery that occurs, for the example, the top 1% and the 20% is phenomenal. You can see that with the dark blue line at the very bottom, there was some loss that occurred, and it doesn't seem like any part of it is recovered. The recovery that the economy was experiencing was a really one-sided story of recovery for a lot of capital holders, recovery for a lot of the wealthiest part of the income distribution. But when you're talking about recovery for average households, working class households, that doesn't seem to really manifest itself in the data. And this can easily be stratified by race. You can see that the wealth gap, including the gap in recovery, is far different for Black versus white households and for Hispanic versus white households, with only really the top portion of the income distribution within either non-white racial group getting anywhere near the shape or size of the wealth recovery that happened for the white households. So even looking at this and seeing that white households having an average wealth in 2016 of 163,000, that has to be contextualized in that even for white households, there's going to be inequality in the distribution of income, and that higher wealth in 2016 is masking the range of how wide it can go north for all groups here. And that range is going to be much smaller for the non-white groups. And it's important to note that because even though this can be stratified along racial lines and needs to be stratified along racial lines, because that is how a lot of this inequality manifests itself, there is even inequality in the aggregate of the data. It's part of this American narrative. The other inclining risks, the global economic slowdown in 2019, manufacturing most likely entered a recession in 2019, and largely due to the China-US trade war that was occurring. Trade barriers and tariffs just don't play well for manufacturing with their large supply chains going all across the globe. Globally, or looking more globally, there were pressures in Germany, stagnation in Germany, also likely due to the US-China trade war and Germany's manufacturing powerhouse being also very susceptible to these supply chain disruptions. The final portion of the inclining risks I wanted to talk about was something I call the socioeconomic last mile. So on a more macro lens, Western society is aging, and depending on a smaller, older, and in many ways sicker workforce is supported. This trend exists in the UK, it exists in Germany, it exists even in Italy. None of these places are exception to this growing growing proportion of workers over the age of 55, making up larger and larger proportions of the workforce. And this actually isn't even just a Western phenomenon, right? The same thing is happening in China, same thing is happening in Japan. This is in many ways happening across the globe in developed and developing nations. It's part of the issues that happen typically with economic development, where the as we notice economies developing, they tend to have lower birth rates that lead to a self-fulfilling cycle of each workforce becoming progressively older and older as far as what proportion of it is at the age of 55 and above. And yet the same thing is happening in the US as well, whether or not you're talking about 55-year-olds and over as a proportion of the population or as a proportion of the workforce. So in 2009, December 2009, 18% of the US working age population was over 55. That grew to 20.5% by 2019 December. At the same time, we have to consider the health and well-being of the workforce, right? The prevalence of non-communicable diseases has been rising in the United States, although the change in the percentage of deaths from non-communicable diseases has been pretty minor, inching up from 88% in 2009 to 89% by 2017. The incidence of most major non-communicable chronic diseases in the U.S. has risen since the 1980s. And you can see the incidence for diagnosed heart disease is really the only one that has a modestly downward trend in it on this first graph. Diagnosed cancers and diagnosed stroke both have been rising. So have, for the most part, hypertension and high blood pressure, which both continue their upward trend since the Great Recession. Undiagnosed and diagnosed diabetes and hypertension. High blood pressure has been on a decline since over that same time period, but flatlined after the Great Recession. All of these are what you'll see that as we get further into the presentation, this idea of the makeup of our workforce, the health of our workforce, the aging of our workforce is important in understanding how this correction occurs and how it plays out for our economy. Finally, it's necessary to note that these non-communicable diseases are more prevalent as far as the rates of incidence in non-white populations. You can see I've compared white, black, and Asian instances, and for diagnosed heart disease, cancer, stroke, diagnosed and undiagnosed diabetes, hypertension, and blood pressure. And for most of these categories, the non-white populations have higher incidences of these. So altogether, these are really intertangling risks that create a interesting scenario going into this event. The high corporate leverage and low oil prices make for a pretty powder keg scenario, with some firms in the fuel and energy industry relying heavily upon debt for their derived cash, with them looking at diminished profit margins from their products. At the same time, we've seen uncertainty stemming from the anti-globalist populist movements across the globe, and that has disrupted industrial manufacturing also across a good portion of the globe, while weakening supply chain stability across sectors. At the same time, the workforce has been aging and in many ways getting sicker over time. These qualities factor into what we would consider population susceptibility, which is important in understanding the public health side of how this may interact with the economy. In this case, interact in the sense of defining how deep into a recession we may be driven. I mean, we have to ask questions like how many people will drop out of the workforce from illness or death, how costly would it be to stabilize the population, and how costly will it be to also return survivors to working status. Socioeconomic vulnerabilities become comorbid when the unhealthiest segments of society have the least resources to deal with the consequences from that. So moving from the inclining risks, let's talk about some of the immediate causes, looking at the Russian-Saudi Arabian oil price war, the Great Lockdown itself, and of course, SARS-CoV-2 and COVID-19. So leading into this, more on the more immediate side was the Russian-Saudi Arabian oil price war. Although arguably this war started after the lockdown began, the factors that led to it started well before this, and in some ways have their root in the 1970s oil crisis, when OPEC responded to our involvement in a lot of its partners and trading partners' war with Israel. Oil-rich economies have been stressed, though, for years, and they've been stressed because they've been drenched in a surge of supply of oil from emerging new net producers in the United States and other nations like Brazil, Canada, and Norway. That oil, of course, pushes down the price per barrel and makes the profit margins off of each barrel even thinner. When China went into lockdown, the oil demand dropped sharply, and that forced OPEC to seek lower output levels. Now, the issue when you start looking for lower output levels is that anybody who takes a cut or cuts back on their output, of course, may help to bring the price back up. And you can see that in the supply and demand curve here, where we have an upward sloping supply line, a downward sloping demand line, and the shifting of the demand curve to the left indicates, or is indicative of China's reduction in demand. So that shifting occurs because China drops its demand for oil going into its own lockdown. And you can see that causes a downward push on price from P to P1. Now, if we could move the supply line to the left as well, we could possibly push up the price of oil back to its normal levels. But what you'll notice is that by moving the supply line to the left, we move to an even lower level of output. So when you ask countries in a cartel like OPEC to try to reduce output to restore prices, they understand that the people who do reduce output are taking a real loss in revenue, because there will be less output that they're producing, even if it was at the price level that existed beforehand. Now they're just producing less output, same price level. That means to less revenues. There's always some combativeness as far as figuring out who should cut back on output. But generally, the idea is that Saudi Arabia, being the largest producer, should be one of the members to cut back. But of course, there are other suppliers of oil beyond OPEC. So what occurs when OPEC's the largest oil producer, Saudi Arabia, and one of the other largest producers in the globe, Russia, start to try to negotiate through their output losses. Those negotiations largely started to fail. March 7th, Saudi Arabia and then Russia announced hikes in oil production, which cut the price of oil by 25%. Negotiations ended bitterly as Saudi Arabia then proceeded to announce additional increases in oil production the next day and discounted barrels of oil for select customers, especially those who were trading partners of Russia. All of this leads to oil becoming cheaper, which does reduce the cost for many firms, right? That is something to keep in mind, is that this should theoretically be stimulative if nothing else had changed and oil just became cheaper. But for oil-dependent economies globally, like Saudi Arabia, Russia, and domestically, like Texas, Alaska, tax revenue will likely collapse from this collapse in oil prices. And for firms in the oil transportation or extraction industries, profits will probably be cut or eliminated by this collapse in oil prices. Like I just said during the inclining risks section, a lot of those firms in the oil industry were very highly leveraged because they were already dealing with thin profit margins on a cheaper product. So with prices cut this low, for many of these firms, it's actually almost impossible for them to turn a profit in the short term, which they may still be running in that short term with the hope that this will be a short-lived experience, so that prices may rise again, that they can turn a profit. But I don't know if anybody has ran the numbers to figure out how long some of these firms can go on their cash flows without oil being above $40 a barrel. So moving from that, we get into the lockdown itself. China was the first nation to enter any type of lockdown in reaction to SARS-CoV-2 and the COVID-19 disease. That was on January 23rd. And they were also some of the first to start lifting restrictions largely before the rest of the world even entered the lockdown. On March 16th, the CDC released recommendations that many state and local governments use as a basis to guide their lockdown procedures. At this point, heading into the lockdown, the U.S. was probably right at or above its potential output. So remember, potential output for the economy being, in effect, a measure of what the economy could do if all utilizable resources are utilized. So we're probably somewhere there or right above that getting into the great lockdown. The coronavirus pandemic and degrees of mandated social distancing, though, lead to the short-run aggregate supply curve experiencing a shock that then feeds into the aggregate demand curve slumping. So I'll get into a bit of what we were talking about with that. First, right, China's lockdown exacerbates the supply chain issues that were already occurring from the China-U.S. trade war, and that shifts the short-run aggregate supply curve to the left as suppliers of products domestically have trouble sourcing those products and therefore have trouble supplying as much output, with China basically offline trying to deal with its first start of the COVID-19 outbreak. After that, the virus emerges in Italy, Japan, and the United States, causing delayed lockdowns and simultaneously shifting the U.S.'s aggregate demand and short-run aggregate supply curves to the left. So you can imagine some of the causes for why we start to see less output from the supply side, as well as less demand side, less aggregate demand. We're seeing a reduction in tourism. These nations are not only nations in and of themselves, but also feeders of tourism or of tourists into much of the United States. Reduced business activity from labor migration, right? As soon as these lockdowns start occurring, the ability to send people across borders for efficient work in different nations starts to fall apart. People are more likely to lock down in place, which not only leads to less activity for transportation, but also less activity for peripheral industries. The person who would have sold breakfast to that traveling worker, X and Y's like that. On top of that, we have what are probably rational expectations from the supply side. I'm sure producers anticipated that if a lockdown is occurring or going to occur, then I need to shift down my production I may even need to lay off some people because who am I going to produce output for if there is not going to be enough demand in the near future? So that also contributes to that short run aggregate supply curve shifting to the left. And of course, reduced consumption from sheltering in place and climbing unemployment levels, which is how this becomes cyclical, right? As people consume less because they're sheltering in place, they feed into the loop of requiring less output from the supply side, which means the supply side hires less people, which reduces the level of demand and further increases levels of unemployment. I've seen some analyses where this gets broken down into a self-fulfilling cycle, but clearly with Keynesian economic thinking and hopefully some general common sense, fiscal and monetary policy should interject into this interrupt this process with stimulus. And we'll see what that looks like in a short bit. Finally, for the media causes I'm picking out here, the SARS-CoV-2 novel coronavirus 2019 and COVID-19, the disease. Of course, there's always going to be debate whether in the absence of a lockdown in the US, if the novel coronavirus would have caused a recession, but arguably economic activity was already being disrupted by the Chinese lockdown, and just concerns domestically over health and mortality impact may have been enough to diminish consumption in many of these industry areas already. Regardless of whether or not it would have done it on its own, it's hard to argue that this isn't a situation similar to 9/11 and the 2001 correction or recession, where an external shock is all that you really just need to push this way over to the edge. Whether or not SARS-CoV-2 was the shock itself or would have been enough on its own is kind of irrelevant at this point. Here we are. In many ways, the virus's devastation is really amplifying socioeconomic inequalities. Those with non-communicable pre-existing conditions make up almost all of the hospitalizations, and I'll talk about this a little bit further in. This would imply, with the data that we were looking at a little bit earlier, that non-white workers would be particularly susceptible to hospitalization then, and would also have the least net worth to handle the consequences, like the cost of hospitalization itself, the cost of lost employment. None of this should really surprise us, though, because similar mechanisms were at play during the Spanish flu. You can see in the graph there the racial difference in death rates between whites and blacks spikes in 1918. And it's a similar tale where inequality socioeconomically manifests itself into actual higher mortality rates, actual health disparities. That's always been the case, but becomes even more visible when you have health crises, acute, sharp health crises like these. This already culminates into a treacherous waltz into a contraction. The price war between Russia and Saudi Arabia just dropped the price of oil even further, threatening a lot of firms that are already on the brink of profitability. The global shift into a lockdown decimated aggregate supply and demand almost simultaneously as in-person economic activity was, for the most part, paused. And COVID-19 poses a health and mortality risk that undoubtedly is enhancing the negative shocks from the lockdown and the price war consequences. So now a bit more on the slope and bend of the recession. What will be the impact of potential output? What should we expect the shape of the loss to look like? And what should we expect from job losses? So impact on potential output. Why analyze potential output? There will be effects on the cyclical output of the economy. Like, yes, there will definitely be a downward trend. There will definitely be a downward shock to the cyclical economy. That's not necessarily a no-brainer, but it's almost more worthwhile for us to consider what would this event possibly mean for the potential of what the economy can do, which is different from the cyclical economy. The cyclical economy can be very volatile, but we expect that the potential for the economy represents a lot more of the durability of what our economy has built up. We consider potential as a factor of the labor force, the size of the labor force, the productivity of the labor force, the productivity of technology, the productivity of capital. what would this event mean for all of those factors that are much more meaningful when analyzing economic growth in the long run? It'll probably be easier to focus a lot more on the second and third quarter of 2020, just because the potential for a resurgence in the later quarters makes it it's very wishful to think that we can forecast what may happen that far ahead with such a unique and acute event. So the first thing to think of is the health impacts from COVID-19. There will likely be a hit to the working age labor force, but that depends on a couple of questions. How many people are dying from COVID-19 versus with COVID-19? And that question would feed into naturally how many COVID-19 deaths are therefore new versus how many are substituting deaths that would have occurred in the same quarterly time frame. I put on a graph here the daily COVID-19 deaths on top of the 2018 average daily death count, which was a little bit under 2,000 people a day in the United States. Clearly, the misleading part of this graph is the assumption that all the daily COVID-19 deaths will be on top of our baseline average deaths for the year. While it's almost impossible to argue that these deaths have been very compacted into a short amount of time, it would be reasonable to assume, and we'll see in a little bit why, but it would be in many ways reasonable to assume that some of these deaths may have occurred within some measure of a time frame, either within a quarter or 2 quarters of where we are today, and therefore that some of these deaths are in effect replacing deaths that would normally occur. That is important because if we're talking about the labor force, then we have to know what is the above and beyond impact of this on the labor force for the US. So in this graph here, I break down for you the percent of hospitalized COVID-19 patients with pre-existing conditions in March of 2020. Why would there be any suspicion that some of the COVID-19 deaths are even substituting average deaths? Well, when we look at the patients hospitalized, 85% of the hospitalized working age COVID-19 patients in the US likely have a pre-existing condition. Over half of them are obese, a third have hypertension, and a fourth have diabetes. Over 26% of the deaths in March and April of 2018 among the working age population were from cardiovascular disease and diabetes. So now we have the difficult job here of trying to decipher how many COVID-19 deaths with those traits would have happened during this window anyway, because any deaths that would have been above that would then be deaths that we'd have to consider against the size of the labor force and as having a real impact on the labor force in the US. On top of complicating that is the fact that death counts in 2020 are actually about 3% lower than the latest comparable from all deaths in 2018. Obviously, some of that decrease is due to the sheltering in place and the lives that have been saved from sheltering in place, both from the avoidance of accidental and other kinds of deaths versus both from that and from the avoidance of deaths related to externalities like pollution and such. But also it's likely that some of the deaths that would have occurred are happening anyway with a COVID-19 diagnosis. So it would seem reasonable to deduce that with enough time, we're going to realize that there are people who may have died with the diagnosis rather than from the disease itself, that there are people who were already so sick for whatever various reason that they would have died anyway. But it's the new deaths that are due from this that we would want to consider as how they would impact the labor force and then impact potential output. I break that down here where we're talking about the deaths that would have been non-cyclical will actually contribute to a contraction of potential output for the US economy. Now, the shape of the loss is something else, right? Understanding the shape of the loss from this unique recession may require considering a few prior examples. So I propose to you, first example, the 2001 recession, which at least gives us an idea of what a change in potential output for the U.S. looks like in reaction to an external shock, the 9/11 terrorist attacks. What we tend to see is that there was a slowdown in quarter-to-quarter economic growth, but there was no real contraction. We went from 1.06% growth in 2000 quarter one to 0.72% growth in 2002 quarter one. And there are other many dissimilarities, but it's at least interesting to see that even with an external shock, there is no real contraction that occurs in the potential for the economy. A second example, the early 1980s recession. This one is particularly useful to look at because it's a recession that was intentionally caused by the Federal Reserve to try to clamp down inflation. It's also an example of what a double dip pattern would look like. So we have two recessions within a very short time frame pictured here. And it may be part of what we might experience if there's a resurgence of COVID-19 sickness in the winter, during the winter flu season. So during the 1980s, there was also a slowdown in quarter-to-quarter economic growth, but there was no contraction, going from 0.9% growth in 1979 quarter one to 0.4% growth in 1980 quarter three. The issue with this one, the main shortcoming, is that there was no real external shock. The Federal Reserve knew when they were going to start raising rates. They, for the most part, did a paced enough rate raise that business industry was able to see what was happening and did contract their output in recognition of that. It was a very, in many ways, it was a kind of controlled scenario that isn't necessarily exactly what we're experiencing right now, but interesting to see what happens during a intentionally caused recession. So we can turn now to what the IMF is projecting globally, at least, and they're projecting something that we would call a U-shaped year-over-year growth recession with cyclical output contraction. So there will be year-over-year growth in the economy, but the cyclical output of the economy would contract, which would mean that what you see in the graph here, we're going from, let's say, an index baseline level of 100 points in 2019 for the economy. And we see in 2020, we dropped down to around 98, a little bit close to 97, basically setting us back to where we were, the levels we were at 2018. By 2021, we're back to above our 2019 point, but the difference in our trajectories leads to $9 trillion of output loss globally, or what the IMF is describing as a 3% contraction in the global economy. That would be about 30 times greater than what we saw globally during the Great Recession. And this dismal picture feeds into their understanding of what's going to happen for the United States economy. The IMF predicts the U.S. economy will contract 6% during the Great Lockdown, which is also about 3 times the contraction during the global financial crisis. If you take a look at the graph to the left, you can see what their projections are for the Great Lockdown contractions compared to what happened during the financial crisis, both for advanced economies and emerging economies globally, and also for the United States, the Euro area, and Japan specifically. So what does that mean for us, a contraction of that depth? Most recessions are marked by contractions also in real gross private domestic investments, how much investment happens in our economy. And what we see is that real gross private domestic investment, RGPDI, contracted more than 20% year over year in 2009. Contractions in RGPDI imply that there will be contractions also in potential output, because private domestic investment in the economy revitalizes the capital that was depreciated over time. So the amount of investment that happens in our economy is a determinant of how much capital exists in the economy, which determines our level of potential output. So in 2009, we know that there was barely enough investment in the economy to replace depreciated capital. What will happen to capital investment in 2020? Will it actually be enough to replenish the depreciated capital? Because if it isn't, it could actually mean a contraction in real economic growth for the first time for the United States economy in decades. What you'll see here is that I have shown you a time series of percentage change from a year ago in various components of GDP. You have government consumption and expenditures in red, real gross private domestic investment, RGPDI, in green, and personal consumption from households in blue. And you can see that the green line, the private domestic investment, is the most volatile component of GDP. It dips down tremendously during recessions. And if I flip over to this next graph, you'll see that when it dips down, the actual economy, real gross domestic product, the total output for the cyclical economy, dips down as well. And when that dip happens, we also tend to see a decline in potential output for the economy as well. So the chain here is thinking that the level of investment in the economy is a significant influencer on the direction and magnitude of the change from year to year in the cyclical economy, and is also a direct determinant of the potential output for the economy. So as you can see, whenever the economy starts declining or starts contracting cyclically, potential output starts to follow it down in that direction. The latest situation had potential output still growing in 2009, even as the cyclical economy, real cyclical economy, contracted by over 3%. Does that mean a contraction that is even further, though, may drop potential output into a contraction? The final thing to consider would be the job losses, right? And this is where it's probably the most unnerving portion of everything. But since the recession, since the 2009 recession, we added around 22 million jobs to the U.S. economy. Virtually that entire number of jobs added was eliminated within a matter of weeks between March 14th and the end of April. During the Great Recession, the U.S. lost a quarter of the 26 million jobs we've lost over that time period now. And we think like part of that is due to the more lax unemployment insurance qualifications that we've allowed for this time. There are definitely people who would not have qualified for unemployment during the last recession who, due to the fiscal policy responses now, do qualify. But all this does point to the fact that we should expect real personal consumption expenditure to drop sharper and deeper than it did during the Great Recession. And you can see the graph in the back shows personal consumption expenditures compared to employment levels, and you can see that they follow each other pretty well during the last recession. Consumption expenditures dip in reaction to with people reacting to the observed job losses and the need to buffer their household finances against the potential for job loss. And personal consumption doesn't really start to recover until jobs start to come back up, or the job growth rate starts to change into the positive. So all of this is really beyond what we could have probably imagined, even with the warnings of a recession back in 2019. The impact of this recession on our real potential output is more meaningful for understanding the permanent effects, yet it's unclear how much of some components of potential output will actually be impacted by the recession. For example, we're not too sure what the permanent loss in the labor force will be from COVID-19. If any loss of life, the lives saved from sheltering in place could drag down potential output. The most realistic assumption is that this will be deeper and sharper, though, than the Great Recession. And it could be a double dipper if any of the initial causes or second order events from those causes reoccur during the fall. A deep contraction in cyclical output is usually accompanied by real potential output moving in the same direction. likely because of the fall in capital investment, and a recession that's deeper than the Great Recession could make real potential output contract for the first time in nearly a century in the U.S. Job loss trends since mid-March reaffirm that this recession will likely be much deeper. Job losses are the best kind of data that we have at this point, with them only being on a weekly lag, and the fact that we're seeing 26 million jobs lost within a month and a half is unnerving. At least if you were hoping that this wasn't going to be as deep as the Great Recession, but that sharpness doesn't tell us about what the recovery will be, which I have intentionally not necessarily covered in much depth here. The recovery could be as sharp, it could not, but it will depend on whether or not certain things fall into place before the likely resurgence in the fall. So what does the impact look like for the city specifically? First, we start off with the fact that our city is one of color. Our city is over 65% non-white, according to the latest census estimates. And the city is also not exclusive from the health and wealth gaps that mark the rest of the nation. It would be a whole presentation on its own to stratify this data, but take it from me and look into it if you would like yourself, that most of the data on wealth, income inequality, health disparities that is prevalent across the United States is also in many ways prevalent within New York City. On top of that, this is one of the most segregated cities in the nation, and the graph you're looking at behind this shows census block data with one dot representing a person and the color of that dot representing the race of that person. And you can see just from the colors and how they are very distinct from each other on this map that there is a large amount of racial segregation in how people geographically live, or where they geographically live in New York City. The CDC has identified that segregation and urban density as one of the risk factors in COVID-19 hospitalizations. This is all mentioned because we do see different disparities in the health outcomes of people with COVID-19 within New York City. So no surprise, the CDC has identified Blacks as overrepresented in hospitalizations, and both Blacks and Hispanics as overrepresented in the deaths. And this points to the reality that New York City's labor force is particularly at risk due to segregation and other structural inequalities that are fixtures of the city and make health outcomes in the city much more dictated by your race and other things that are proxies for race than they are by simply the fact that you are living in New York City. Across the state, job losses have been pretty severe compared to last year. By the end of April, over 1.5 million New Yorkers filed for unemployment benefits, and job losses are the highest in New York City compared to the rest of the state. The job losses across the state, though, have been concentrated in low-skill industries like accommodation and food services and retail trade, which are also the industries that are usually overrepresented by people of color. So the job losses are definitely hitting communities that have the most socioeconomic vulnerabilities in the state. And we can see that a bit in the demographic breakdown of people who are applying for UI benefits now versus last year. UI applicants today are more non-white than they were last year, and they are in particular more more represented by Asians. On top of that, more of them are women, or a larger proportion of them are women, and a larger proportion of them are under 25 years old. So people who may have other socioeconomic traits that would make this data concerning, right? We're talking about segregation that occurs both along racial and gender lines. Young workers typically have the smallest or the shortest employment history, and makes them very vulnerable when these type of situations occur, and they're usually the first ones to get laid off. Cumulatively for the city, we're looking at 624,000 people who have applied for unemployment insurance since the middle of March. And looking at the impact of this in consumption, we have some more innovative data sources today. OpenTable, for example, shows us that reservations are basically dropped to 100% down by the time New York on pause was implemented, and revenues are probably falling in the same fashion. We also know that dining out is one of those things that's a complementary good. So if dining out is dropping, right, if people just can't really dine out or not dining out as much, then leisure and tourism related industries in general are probably falling too, which would lead to a fall in the related tax revenues. If we're looking at flight data, departures from JFK, LaGuardia, and Newark have dropped significantly since the end of March. Actually, they've almost halved since the end of March, which is very telling. And many other measures of economic activity in the city, ridership down dramatically, going from 28 million riders on February 29th to 29 million riders down to 2.8 million. Traffic speeds have increased significantly in the major highways. Hotel occupancy rates have dropped to a fraction of where they were even in February. Restaurant revenues down almost 100%, and Broadway attendance is null at this point. So the city is growing less active as the lockdown continues, and that is having an impact on the budget side. So spinning over to the mayor's proposed budget, we see that there is a revenue shortfall of about 2.2 billion through the end of June compared to the estimates made by the office in January. And in response, New York City will cut about $2.6 billion in expenses. Next fiscal year, the city is looking at a $5.1 billion shortfall and plans to cut nearly $4 billion in expenses in response. Those revenue shortfalls are coming from all the usual suspects: sales tax dropping by $1 billion, personal income tax expected to drop by $2 billion, and corporation tax is expected to drop by $1.1 billion. And of course, those expenditure cuts, they're coming from maybe not the usual suspects, but understandably, because local fiscal policy is usually cyclical, and that when the economy gets worse, the fiscal policy starts to become contractionary. We shouldn't be surprised that the mayor's office is trying to close the gap by pilfering the retiree health benefits trust of about $1 billion and making an additional $500 million in cuts from personnel services, which are employee expenditures. So this is what happens during a recession for any local government, right? There is usually a pilfering of savings for future groups as much as there can be legally, and which is basically borrowing from the future as much as you can, and cuts in headcount, things like personal expenditures for employees. So really, when the Big Apple pauses, we all suffer. The city's hemorrhaging jobs, and they're hemorrhaging jobs that are usually held by the people who are most socioeconomically vulnerable. And in this situation, because it's a healthcare crisis, this vulnerability gets amplified with health disparities across the city that could be stratified by race. The best indicator suggests that because of the governor's on pause initiative, the city's economy is likely contracting, with most kinds of profitable economic activity falling. And because of the reality of diminishing revenues, the de Blasio administration is proposing billions of dollars in cuts to the city's budget. One way or another, city services will likely suffer and job losses will happen in the government sector. This is the nature of local government budgeting. So now moving to the more federal level, what are the Federal Reserve's actions in response to this, and what have been the fiscal action responses to this? The Federal Reserve has taken on about $2 trillion more to their balance sheet in the form of assets, while taking actions against the Great Lockdown Recession. The actions they've taken fall into three broad buckets. That's monetary policy actions, central banking actions, and actions that they've been allowed through special permissions from the Treasury Department. So looking at monetary policy actions, there have been a few familiar tools used. Interest rate has been cut. The federal funds interest rate has been cut by 150 basis points, in less than a month to nearly 0%. The Fed has already indicated in the past that they are unwilling to go into negative territory, despite some published evidence that negative interest rates might have a more stimulative effect on the economy. It's still not clear that would be helpful this time around, and the Federal Reserve has had cautions around using negative interest rates in consideration of money market funds. There's also been employment of forward guidance, which is from the Federal Reserve signaling that they will commit to low interest rates. I have a quote here from Chairman Powell. Until we're confident the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals, they'll be keeping rates low until that moment, which is vague, but a commitment that the Federal Reserve will hopefully see this through as much as they have in other recessions. The Federal Reserve has also returned to quantitative easing, with asset purchases resumed, and they have been made open-ended. So even though it hasn't been just really explicitly said, we're basically back into quantitative easing mode, and is part of why that asset balance sheet has grown by $2 trillion in such a short amount of time. The central banking actions were mostly geared towards stabilizing markets for the government debt and opening up the liquidity faucets. So we're looking at around $30 billion of treasuries purchased to try to stabilize markets in the treasury area. Moving forward, planned reinvestments that they already had. So this isn't an additional $30 billion in purchases, but $30 billion that was planned in the future and is being moved forward. In their lender of last resort role for the Federal Reserve, they're lending around $1.5 trillion to the repo market to try to stabilize the repo market. Repo market basically is one where short-term loans are made to banks that use treasuries as collateral. The Federal Reserve is stepping in to make those loans to the banks that want to use treasuries as collateral. The Federal Reserve is also dropping their discount window rate to be at a level similar to the federal funds rate, and they're extending the term on paying back those discount window loans to 90 days from overnight. So they're trying their best here to create an environment where liquidity can flow through easily and they can fulfill their lender of last resort role. You'll see that they're trying to even extend this role a little bit further in the next slide. But the Federal Reserve is also using their regulatory power to relax capital regulations so that banks can use the capital that they had on hand in case of an emergency to actually make loans now. So the required reserve ratio is suspended, and this is hopefully why we have these macroprudential policies, right? This idea that we have the banks hold higher capital ratios so that when times like this come, you actually have a faucet to turn on. The Fed has also gotten a range of special permissions from the Treasury Department to use unconventional lending facilities. These take the role of things like the primary dealer credit facility, loans to securities firms as low as 0.25% interest, loans to banks that buy assets from money market mutual funds, $100 billion in loans to banks that provide consumer credit, $10 billion of that $100 billion being covered by the Treasury Department, $750 billion in lending through the corporate credit and commercial paper funding facilities, another $600 billion in small business loan lendings, which take the form of the Federal Reserve supporting banks that are making Paycheck Protection Program loans, and municipal liquidity facility, which is offering $500 billion in loans to state and local governments, with about $35 billion of it covered by the Treasury's expenditures. So we're looking at over trillions of dollars going into this from the Federal Reserve side. A lot of it is in the form of loans, so the Federal Reserve is expecting that this won't have a real impact on their asset sheet. This is basically them taking their lender of last resort role and extending it further than they ever have before. On the fiscal policy side, the federal government has allocated over $2.5 trillion to fiscal measures aimed at supporting the economy through the great lockdown. Are spread out over three phases. We'll go through the three phases and the 3.5 phase real quick. Phases 1 through 2 account for about $100 billion, and they're largely policy laws that were enacted to allow for vaccination research, prevention, treatment research, and to expand paid sick leave, SNAP, and unemployment insurance benefits. These were modest phases that started at first during like the early days of the Great Lockdown. The big phase was phase 3, the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. We'll shorthand this the stimulus package right now. Over $2 trillion in fiscal measures, direct payments, and loans. $1.5 trillion of that was in what we would call increased outlays. So, for example, $500 billion in direct payments to individuals, $300 billion of that being household payments, and $250 billion unemployment insurance. $800 billion in small business administration loans, which were $350 billion, and in major industry loans, which were another $454 billion. Those loans include the Paycheck Protection Program, which is meant to help small businesses keep people on payrolls in the short term to try to weather through the crisis, and $454 billion in emergency lending to back some of the Fed programs that I described before. So while the Fed is doing its lender of last resort thing, the Treasury Department is basically in a position now to backstop any of the loans that may fail by providing real cash to the Fed if necessary. The other part of the $2 trillion, so that was the $1.5 trillion in outlays. Another $446 billion comes in the form of decreased revenues for the federal government. So that is for example, 220 something billion in tax deferrals and deadline extensions. These are things that are supposed to help individuals manage their liquidity personally. This also all includes, right, the stimulus checks that people were receiving. All of this is the federal government taking the role of, we need to keep the economy afloat while this situation occurs. The lockdown is something that has been intentionally enacted, and now theoretically the perfect role for fiscal and monetary policy should be to make sure that nobody cares that the lockdown is happening because they have enough cash to go about life as usual. For that reason, it's expected that phase 3's fiscal impact is largely going to be in this and next year, although the $1.8 trillion in costs will be spread out over the next 10 years in the federal budget. Finally, there's a phase 3.5, which is really a re-upping of the Paycheck Protection Program and other SBA loans that ran out of money by April 16th. So portion of phase 3 ran out of money pretty quickly, in part because some of the firms taking advantage of phase 3 were larger than even some of the lawmakers had anticipated and based on what was written. So a lot of that money was depleted quickly. Some of those firms did return back their grants to the federal government, but there was still a need to re-up the program with more cash after mid-April. So again, policies of lockdown, right? Keeping an economy afloat during the lockdown. The Federal Reserve was the first to act, taking measures to stimulate economic activity ahead of the slowdown. As the lockdown became more inevitable, though, the Fed's measures turned toward maintaining functioning national debt markets, instilling confidence, including a fiscal policy, and providing adequate liquidity. Fiscal actors were slower to react, but likely faster than in most recessions because they had information from when lockdowns were going to be happening and should have been able to act in a fashion timely enough to prevent this from being really a painful correction. I guess time will tell how effective that is, but even now we're seeing so many issues in UI systems across the country that was probably side of this not expected by from the federal level, because the U.S. systems are managed by the state and local governments. Many of them were not prepared for this surge of unemployment claims, and it's going to be interesting how much that contributes to the depth of the contraction and the actual pain from that. And finally, there is already talk at this point, at the end of April, of a phase 4 that might take the form of maybe 500 billion or so to bail out state and local governments. So will any of it work? The store is closed, but inevitably should reopen, right? All of this from the fiscal actions effectively amounts to what some have been describing as coupons to a closed store. It may make more sense to expect fiscal stimulus to serve less of a stimulative role and more of a stabilizing role, so that households can make their way through waves of this virus without real disruption to their daily lives. But this might, in the longer term, be an opportunity to investigate what universal basic income frameworks can look like. Because right now, the question isn't really supporting people until they can get a job, but more so supporting people until the economy turns on again. And it's hard to imagine the ways that we would use to support people while the economy is off would be vastly different from the ways that we would want to support people through a universal income framework. How successful this is at working will depend also upon perceptions of safety and security. A few people have been citing that from the 1918 flu, there wasn't really a recovery until there was an actual grasp on the flu's expansion. So in many ways, we may expect that there won't really be a recovery until people feel like it's safe enough to go back outside and to pursue their normal economic activities. So in many ways, it's going to depend upon how good we are in managing the outbreak and the fears around it. It also depends on the rebound of the virus upon the reopening of the first phase of the Great Lockdown. As soon as we reopen, it'd be hard to imagine there wouldn't be even a small resurgence of cases as people start to interact with each other again, unless we assume they have been in many ways already. But if they come out of the lockdown, there would probably be some level of a resurgence. And should we expect other lockdowns for the next few years? It would be hard to imagine that this could not become a regular fixture of our cyclical life, how we have a cyclical flu season. How well we adapt to building capacity for a cyclical coronavirus of this type will probably say a lot about whether or not we have more lockdowns in the future and whether or not whether or not we actually fully recover from this recession. Because as we know, the 2008 one took a while to recover from. It is feasible. It's feasible to imagine that this could as well, or it could be a sharper recovery. All depends upon how well we adapt to all of this. So, references for anybody who may want to take a look. Hopefully this has given a more clear rundown on how we got to the Great Lockdown, what the anticipated impact will be on the city, what the Fed's both monetary and fiscal side have been doing to react to it, and where we'll go from here. It'll be fascinating in some years or even in some months to look back to see, even at this point, what else occurs and what else reveals itself to us with better analysis. All right, thank you very much.